What I'm going to reveal in this video is going to change your trading life. Today, I'll explain market structure in a way that covers everything step by step, and if you miss even a single step while applying this concept, it can completely affect your trading. By the end of this video, your entire perspective on trading will change. So let's not waste time. Let's get into the video. Step 1 is understanding the different types of market structure, which include uptrend, downtrend, and range. Now let's start with the first one. If you can see here, the market is clearly moving upward. I am saying this is an uptrend. Simple. Why am I saying this? Because the market is clearly moving from this point to that point, which means it is moving upward. That's it. But you might think this is simple. Yes, it looks simple, but there is a lot more inside this concept, and I will explain everything by the end of this video. Now let's move on to the downtrend. As you can see on the chart, the market moves in the opposite direction of the uptrend. In a downtrend, the market moves to the downside. Now the third one is range. This is also simple to understand. In a range, price does not move clearly up or down. Price gets stuck inside a zone. Price will not move anywhere. It will just move back and forth inside the range. So that is called a range. Now you understand the basic overview of the three types of market structure. As I said, there is a lot more depth in this topic. Now let's move forward and discuss this in detail. So here's the list, guys. The first one is higher highs and higher lows. Before that, let's discuss this in the uptrend. I have explained this on a single time frame to make it clear. I hope it helps. So if you can see here, the market moves up. Then I am just marking the first points. I am marking these higher highs and higher lows. Later, I will explain this. First, as you can see, price moves up. Now the price comes down. Again, it moves up. And here you can see I have marked the higher low. Why did I mark these points on the chart? Because there is a logic behind this. First, as you can see, when I mark this higher low, there is a previous low point. This current low is higher than the previous low. When this pattern repeats itself again and again, we mark the lows as higher lows and the highs as higher highs. Simple step-by-step, think like this dash dash. Lows are higher than previous lows. Same goes for highs dash dash. Each new high is higher than the previous high. Now let's move to the next thing, which is swing highs. So simply, higher highs are the swing highs, and higher lows are the swing lows in the market. Why am I saying this? Because these are the obvious points in the market structure in an uptrend scenario. These are the peak highs and peak lows. Whenever you look at the market structure or the chart, you can clearly see these obvious high and low points. These are called swing highs and swing lows. Next is impulse and pullback, which is a concept in the uptrend market structure. These are the impulses, and these are the pullbacks. In impulse moves, price moves with strong momentum. Price moves aggressively during impulse moves because this is an uptrend. So you need to understand the logic here. In an uptrend, bulls are very important because there is strong bullish momentum. Buyers are more active in an uptrend market structure. That's why it is called an uptrend. In impulse moves, buyers are more aggressive. In pullbacks, sellers are less aggressive and have low momentum. So, obviously, more buyers in an uptrend, less sellers in corrections. Buyers always win in an uptrend. To understand this clearly, the next thing we need to understand is break of structure, simply called BOS. In an uptrend, price moves up and we get a higher high. Then price makes a correction, which is a pullback. After that, price clearly breaks the previous higher high. That is called break of structure in an uptrend. You need to think, guys. This is a clear representation that buyers are in control. Why? Because as I said earlier, buyers move with aggressive momentum. So we plot their momentum using BOS. Process continues. So here is another BOS. Now another BOS here. This clearly tells us one simple thing. Buyers are in control in an uptrend. Now let's move to the strong and weak points. You need to think like this. Whoever is the strongest in the uptrend. So, as you can see, I am saying the higher lows and the swing lows in an uptrend are the strong points because they make the break of structure. Simple. Whoever breaks the previous points, whoever is controlling the structure, those points are called strong points. So simply, the downside points from where price breaks the structure to the upside in an uptrend. Those are called the strong points. On the other side, whichever points get broken easily, they help us understand the structure. So here, in an uptrend, the higher highs are the weak points because they get broken easily and do not hold price clearly. Next is the change of character, simply called CHOCH. When the structure is bullish, with higher highs and higher lows, a swing high and a swing low are formed, and a break of structure also occurs. Since a strong low and a weak high exist, instead of the structure continuing to form higher highs, for the first time it breaks the strong low. Because the trend shifts downward by breaking the strong low for the first time, we call this a change of character. After that, When a pullback occurs and price breaks the previous low to the downside again, we call it a break of structure. Through the change of character, we understand that the market structure has shifted from bullish to bearish, downtrend. The same logic applies on the downside. Let me break this down clearly for the downtrend. So here, the market is clearly in a downtrend. In an uptrend, we have higher highs and higher lows. Now in a downtrend, we have lower highs and lower lows. I think you have understood the uptrend clearly. So now you can understand that these are lower highs and lower lows. Because each low is lower than the previous low, this downside structure is called a downtrend. Next, these are the swing highs in a downtrend, and these are the swing lows in a downtrend. Next, we have the impulse and the pullback. See, in impulse moves, you need to understand that sellers are in control, because sellers move with aggressive momentum. Simple logic. Uptrend and downtrend are opposite. Same concept, just think in the opposite direction. So here are the impulses and here are the pullbacks. In impulse moves, sellers are in control. In corrections or pullbacks, buyers are present, but their momentum is less compared to sellers. Next, we have the strong points and weak points. As I said, when sellers are in control, the strong points are the swing highs or lower highs in the downtrend market structure. Whichever points get broken easily, those are the weak points in a downtrend. They break easily because sellers are aggressive. Now the next concept is break of structure. Here we have the break of structure. These are the break of structure points. They represent the downtrend because sellers are in control. So we mark the break of structure from the weak points that get broken. So this is the clear structure of a downtrend. Now about range. Price is stuck in a range. You don't need to overcomplicate it. There is no clear structure. Price just moves back and forth inside the range. One more important thing you need to understand is range breakout. When price moves back and forth inside a range, and the range gets broken, we get confirmation of aggressive momentum. If the range breaks to the upside, buyers are aggressive and an uptrend may start. If the range breaks to the downside, there is clear downside momentum and sellers are in control. Thank you so much for watching the video. Don't forget to like and subscribe.